Okay, well, let's go ahead and get started. Um, Welcome, everybody. Thank you for taking the time out of your busy day to join us. This should be interesting. I am JC Abusaid, CEO and President of Halbert Hargrove, and I have the pleasure of introducing Mr. Brian Spinelli. So I've had the pleasure of working with him for 18 years, and he's held many roles. He's gone through the ranks in the firm, and with his latest role as being a senior wealth advisor, and of course, the more recent role change being our co-CIO. And of course, as it would happen prior to this webinar, markets have done a couple moves. There's been a little extra volatility starting late last week. So with that, I want to introduce Brian Spinelli, our co-CIO, with this mid-year update. Go ahead, Brian.
All right, thank you. And good morning and good afternoon for those of you who are not on the West Coast. But I'm going to go through a number of things that we're looking at. It's going to be a reduced deck, but if there are any questions at the end of this, we're going to try to leave some room for Q&A today. And then also, if you're working with Halbert Hargrove and you're a client of Halbert Hargrove, your team will have these and be able to address these in your next upcoming meeting as well. If we do not get to all the questions today, please send them over to your wealth advisory team and we'll be happy to address them. So assuming you can see my screen here at this point and all is working, I'm going to start with the mid-year market update. And of course, every time we go to get in front of clients and talk about things, something happens right before. So what I'm going to go over is a lot of data as of June 30, 2024. And then I'm going to work in some changes that have occurred, especially in the last 2 days to that data, which hasn't been, despite what you may see, it hasn't been as material to some of these numbers that I'm going to show and talk through today. So I'm going to cover public markets. What public markets are to us, think of public stocks, US, international, and then also the fixed income markets, both US and international, publicly traded securities. Then get into some economic factors, things to keep top of mind, and then get into some good investment principles and good reminders, especially in light of what's occurred in the last 2 days, which in entirely has been completely normal for what markets in the public space do. So let's start with Candyland. I call this the Candyland chart. So if you remember Candyland, there's a lot of colored squares here. What you're looking at here, each box represents an asset class in the public markets, and it's measured by an index. So if we're looking at the left-hand side of the screen, just real quick, the dark green box that says large cap, think of that as the S&P 500 index measuring large US companies. You see the orange box, small cap, that's small US companies, and then so further on down the list. And going back to 2009 here, just working your way left to right, what you're looking at is in each calendar year, there's a box at the top and then followed by a progression of boxes below it. The thing at the top is the best performing index in that calendar year. So for example, in 2009, in light purple, emerging markets, 79% rate of return. That was the best performing asset in that year. And then you can kind of go through the progression here. What the squiggly line is in the middle, it's an asset allocation of a balanced portfolio that uses all of these to comprise a bucket of returns. And what you'll notice, and this is the stress of diversification, is that as you go left to right and start reading through it, a number of the assets that end up as the top performer in certain years fall to the bottom and vice versa. But one thing to always keep in mind when you're owning a broad basket of all of these is to look at the left-hand column and recognize over time the areas that generally produce the most amount of anxiety or volatility on their pricing generally over time have produced the best rates of return. So with no surprise, with what we've seen over the last 14, 15 years here, markets and asset class returns have been pretty normal relative to their risk levels. The one thing to point out, though, is if you're using cash as a long-term strategy, what you'll notice is that cash is at the bottom of the stack on the left-hand side. And then everything above it generally has been additive to risk, meaning it's going to move around in price a lot more than cash. And I'll share an additional way to look at this down the road. Where we're at, this is year to date through June 2024. US large has done the best. emerging markets and developed international have done positive rates of return as well. High yield bonds, even cash has produced a positive rate of return. Most asset classes this year have produced a positive rate of return. The one big thing that has changed in the last, call it 3 or 4 trading days, is bonds were generally a negative rate of return this year because interest rates had gone up. We've seen a wild swing in interest rate expectations driving bond prices higher as there's been a flight to quality from risk assets like stocks over the last 2 days. We're going to focus on stocks here. I'm going to start with the US. I'll move to international in a moment, but one of the things that I will hit heavily on today is valuations and just where valuations are and how to set proper expectations for, call it, future returns and what you should expect out of markets. What this is looking at is the S&P 500 index, and it's looking at the price over earnings ratio. And it's looking at that as one valuation metric. And what you can see with the squiggly line is it moves up and down and it goes through variations over time. Where we're at on the far right-hand side is we're trading at about 21 times earnings. Now, as of yesterday, it was about 20. So because the market sold off so much and they've had a little bit of a correction here, it's still trading at about 20 times earnings. And you're going to go, what does that mean to me? When we look at the 30-year average, which is that dotted line right through the middle here, the average over 30 years is the S&P trades at about 16 to 17 times earnings. And so when you see a PE sitting at an elevated level, that just tells you the market is somewhat expensive at this point. That doesn't mean because it's expensive, it's going to fall apart. It just means you are overpaying relative to history for those future earnings. And we do go through periods where markets get really cheap like they did in 2009, which creates a great buying opportunity. But I will tell you, very few people wanted to touch the market in 2009 until they saw a clear indication that things were recovering. So we sit at expensive levels today on US stocks. The one thing to note, though, is with interest rate changes, meaning with bonds in particular, having much higher levels of income and interest rates at this point in time, the one thing that we have seen switch within the last year is when you compare the earnings on stocks to the yield on bonds, which is a common thing to do, bonds actually present a better value than stocks at this point, albeit you have to have a blend of them if you're going to be a broadly diversified portfolio, because stocks generally provide a lot more upside. But if you're just looking at the earnings yields on them, bonds do appear more better valuations at this point than, say, US stocks. So what does valuation even tell us? Well, like why look at it? And really, when you're looking at valuations on, say, things like stocks or even bonds, what that doesn't do for you is tell you when to time the market. It does give you an indication of future returns, but it does not tell you if valuations are high that next year things are going to be low. And we can kind of show that here. If we look at the various black diamonds here or gray diamonds here, these were forward PE ratios from a variety of calendar years going back to 1999, just scatter plotted. And if you look at the valuation levels down here, these were the subsequent one-year returns. So you can see that there were some really high periods of return followed by some very low periods of returns, even when valuations were low. And what this does on a one-year basis is it doesn't tell you a whole lot. It's not going to tell you what the market's going to do tomorrow. However, if we go out over a longer period of time, which is, say, a 5-year annualized period, you start to see a lot more clumping. And you start to be able to get a sense of what the next 5 years may look like on an average annual return out of stocks. And where we're trading out right now at 21 times earnings, what that is indicating, if you're using history as any guide here, is that there are and should probably be lower expected return expectations out of US stocks for the next 5 years. It doesn't mean the market's going to fall apart. It just means it may not repeat at the same level that it has been doing for the last 5 years. So it's just something to keep in mind, is that valuations matter, but they matter really more materially to the market over a longer period of time. And getting into where we are with the markets right now and where we've been for the last couple of years is really a handful of stocks within the S&P 500 are really driving that index. And you can kind of see this if we look at the left-hand side. The top 10 stocks, so these are the largest 10 companies within the S&P 500 index, right now are trading at about 30 times earnings. So their PE is 30, roughly 30 at this point in time. Historically, the average of the top 10, because it does rotate through the S&P, meaning the top 10 today were not the top 10 5 years ago. The average of the top 10 usually trades around 20 times earnings. So that's just an indication that those top 10 stocks are pretty overvalued from a sense. It doesn't mean they may not be able to continue the momentum they've had in the short run, but they are expensive relative to their history. The remaining stocks, so strip out the 10 and you have 490 other stocks you're looking at in the large US space, they're trading at about 17.5 times earnings. Average is about 15. So they're slightly expensive, but nowhere near as high as the top 10. And one of the things, if we look back to 1996 here, I'm just going to focus on this upper right-hand quadrant here. Those top 10 stocks, as far as concentration of what they make up of the index right now, sit just shy of 40% of the index. So they have 40% of the influence over the index at this point. And if you kind of just look back over time here, it's never been that high. And so we are in a period where these indexes are something you have to just be aware that there's quite a bit of concentration in them at this point. And one way to lower that is to diversify into other areas potentially, to not have that level of concentration or only 10 stocks really driving an index at this point in time. It doesn't mean flee the S&P at all. It's just be reminded of what's really driving the market. It's not a broad-based set of returns driving markets right now. And to show this a little bit more in detail, I'm going to focus on something that you've probably heard about even in the headlines of news and all of that, which is the Magnificent Seven. So what the Magnificent Seven, for those that are not familiar with it, think of the Apples, the Amazons, the Googles, the Metas. I still like to call it Facebook, even though they've changed the name. Microsoft, NVIDIA, and Tesla. So those have been the 7 stocks really that have produced the most amount of return over the last few years for the index. And if we look in the upper just left-hand corner here, you can kind of see the Magnificent Seven rates of return. If you just take those 7 stocks and combine them together, in 2020, they produced a 40% return. 2022, gut-wrenching -40. 2023, a beautiful 76%. And then so far this year, roughly 33% rate of return on just if you combine those. What that tells us, though, when you break down the market on the US stock side, is that they've contributed over 60% of the return to the market this year. If you take just those 7 stocks out and you want to see how broad is this kind of performance been, the other 493 stocks have produced on a combined basis just 5% returns. So it's a pretty big disparity between those, and what many are led to believe, and at least you'll see some parallels here, that because this is big tech, it's a lot like 1999, 2000, and we're going to have another tech bubble. I don't know if that's going to exist, but what's really big as far as a difference, if we're going to try to draw that parallel, is if we're looking at the green here on the earnings growth, those 7 stocks actually have produced profits and earnings. And they're actually not negative earning companies that are getting high valuations like they were, not these stocks, but like stocks were in the late 90s here. So they have been warranted to have some of their large increases because they've been growing earnings so much. But one of the things to just keep in mind here is that as market expectations get baked in here, those earning growth expectations are not going to necessarily stay at the levels they are. The market is expecting that earnings growth to cool a little bit on those 7 stocks. So just keep that in mind. 7 stocks really doing a lot of heavy lifting for the US index at this point. And remember, if you're going to focus on just 7 stocks, be highly concentrated, you can have pretty significant years in single stocks. And I'll use this as an example. 2022, there was one of those 7 that was down 65% in that calendar year. Would you hold on to it? There was one that was down 27. That was the range of returns of those 7 stocks. And then as we get out to calendar year 2024 for the first half, one was up 149 and one was down 20. The 149 was NVIDIA. The down 20 was Tesla. Now, that just to give you a current update, because last couple of days have been pretty volatile for the Magnificent Seven. NVIDIA has given up a big chunk of that. It's still positive about 100% for this year, but imagine having that price swing on just one piece of your portfolio. It's something to just take note of, that there is a lot of volatility in single names at this point in time. Kind of elevating back a little bit higher up, just looking back at the S&P, and I'll get to international in just a moment here. But this is a reminder for those of you who do have equities as part of your broadly diversified portfolio, or for some of you that it might be 100% of your portfolio if you're very aggressive and have the tolerance for it. This is looking at the S&P 500 price returns going back to 1980. If we're looking at this in particular, what those gray bars indicate in each year, following the timeline along the bottom, that was where the index fell as far as a price return in those single calendar years. The red dots represent simply the largest peak to trough decline within those intra-calendar years. So let's just use 1980 as an example because it's on the far left-hand side here. That year, the index finished up 26%. But at one point in that calendar year, investors had to deal with a 17% decline. And then as you go through time, you'll see that there's a lot of double-digit declines throughout time. The average over that period is roughly a 14% decline. That's normal for a market to do within a single calendar year. Yet, despite all that volatility, 33 out of those 44 years finished positive. So as a reminder, volatility for stock investors is the price of admission to getting higher rates of return. If you're expecting markets to always be calm like they have, call it for the first half of this year, the volatility that we've seen over the last couple of days is not anywhere out of the ordinary or any different price of admission than you've accepted in the past. So just keep that in mind. This is a good reminder for those indexes. So let's move outside the US and start talking valuations and securities that don't necessarily just trade on US markets, and look to the international developed space. Left-hand side of the screen, what this is looking at is the same price to earnings ratio that we were looking at on the S&P 500 just a few moments ago, and comparing it then to how do international stocks that value relative to US at this point. And we look at averages going back over time, which is these purple lines, and then we look at how far outside those averages we are right now. The thing to note with international investments at this point, if you're looking for inexpensive stocks that may not be overvalued at this point, having some international trading at about 36% discount to the average US stock is pretty darn cheap. And if you look at it relative to history, this is the cheapest it's been in the last 20 years. It's even at a point now where you look at this and it's like, how much more of a hurdle do they have? They are very inexpensive. So if you're deploying capital into markets and you don't want to be overpaying for companies, the international space offers that opportunity. The other thing is, if you're looking for some level of income out of stocks, whether that's dividends, as a comparison, the S&P 500 right now is paying about a 1.4% dividend yield. Not very high. If you go outside the US, they're paying 2 times that at roughly 3.2%. So you're picking up a lot more yield outside the US if you want that as part of an income component to a portfolio, to generate some total return as well. So international is still cheap, but like I said, valuations do not tell you what tomorrow is going to be and whether or not returns are going to reflect the better valuations going forward in the short run. The thing to remember, though, is that commonly we're so focused as US investors or US citizens, we're so focused on US markets. There are periods of time where US will outperform international, and then it will flop or flip, and you will end up with very high periods where international stocks outperform. And one of the really big drivers of international having a lot bigger outperformance is if you anticipate any sort of level of cooling off of the dollar, where the dollar starts to decline relative to baskets of foreign currencies, that usually leads to these periods in purple where you have a rotation where international investing does provide some level of diversification outside of just US stocks. at this point. And we kind of saw the last real big period where we saw international really outperform was following the tech bubble blow up. And we've been in one of the most sustained, longest running US outperformance periods relative to history here. So at some point this flips, and it would probably be a good idea to have some level of international at the valuations that they are at today in a portfolio. Moving outside of just stocks now, let's focus on fixed income bond investing. So if you generally have a balanced portfolio, you're going to have some level of bonds in the portfolio that balance out the stock side risk. And the one major shift that has occurred within the last, call it since 2022, when interest rates really started to rise a lot, is that if we're looking at these blue diamonds on the left-hand side, relative to each type of these bonds, so US treasuries, municipal bonds, investment grade corporate debt, mortgage-backed securities, things of those nature. If we start looking at these blue diamonds relative to their last year 10-year, call it median return or median yield, bonds are offering a pretty darn attractive rate of yield at this point in time relative to their last 10 years. And so we've come off very cheap levels of yield at this point, and now we're sitting at places that look more normal to compensate investors for locking their money up in fixed income. The thing with fixed income, which is different than, say, stocks, is those blue diamonds are a pretty darn strong indicator of what your next 5-year returns will be. And so if you're sitting in, say, cash and you're worried about the Fed cutting rates, which is going to reduce the interest rate you're getting today, these are ways to potentially use some of that cash to lock in higher rates for a bit longer, as the market is anticipating some level of cutting to the overnight rate by the Fed this year. It has swung wildly, meaning there was 2 cuts priced in until 2 days ago, and now there's more than 3 priced in for the end of the year. So quite a bit of volatility around what the Fed is expected to do, but nonetheless, fixed income providing yields at this point at very attractive levels relative to its history. And to show this a little bit different way, as we flip through to the yield to worst, what this is just a measure of what you think your bond return is going to look like going forward. So if you buy today, what's that return? What's my return expectation going to be? So if you buy a bond right now or a fixed income portfolio and its current yield, its interest rate is 5%, your forward rate of return for the next 5 years is pretty close to certain at about 5.2. That's assuming that the whole portfolio doesn't default and everybody stops paying on the debt that you've invested in. But if you're investing in investment grade quality type debt at this point or credit, that's a pretty good indication, very strong indication, and it has been over time, of what your forward return will be. So if you're thinking of deploying cash and you're really not comfortable taking all of that risk in stocks or other things, fixed income is providing a good place in portfolios to diversify at this point in time. And to kind of pull this all together, meaning we're going to pull the stocks and we're going to pull the bonds together and look at the valuations across various things at this point. Down at the bottom, you can see treasuries, you can see US core bonds, which are investment grade corporates. You got municipals, emerging market stocks. It's just blending what this is looking at is just blending all these valuations together and then looking at them today relative to their last 25 years. And any of these columns here, if you're looking at this baseline of 0, if it's below that, the valuations today are cheaper than their average over the last 25 years. If it's above that, the valuations are expensive relative to the last 25 years. And so to no surprise, after we've gone through a number of these other slides, bonds pretty attractive, international emerging markets still cheap relative to their averages over time. What's very expensive or continues to be very expensive, US growth stocks and US large cap as a blend. And that's just the measure of the S&P 500 there. So valuations do matter long-term, like I said, but this is just looking at them in all one single area together. And then one last thing on equity valuations before we move on to the economy and some measures there. If we're only going to focus on one thing on this chart today, I would say focus on the left-hand side. And it's about what the market has already set as far as expectations for these various areas. So US equities or stocks, this is the earnings expectation for the next 12 months out of US stocks. It's the gray line. Earnings expectation for the number 2 largest economy in the world, China, are here. And then you can look at Japan, you can look at Europe, ex the UK, and then the emerging markets as a broad basket here. And the one thing to just point to, if we're looking at it, the US has a very high hurdle rate and a very high expectation right now. And what that means is the earnings expectations out of US stocks are drastically higher than the rest of the world. And the idea there is that if they can deliver on that, great, the market won't get disappointed. But if we start to see that earnings disappoint more broadly, this is the part that the market hasn't priced in at this point, the high hurdle that US stocks have. Other countries outside the US with large markets for capital markets, let's use China as an example. Their earnings expectations are already priced in to be pretty darn low. So if they have any level of turnaround or surprise here, that's going to be a positive catalyst for their markets. The same thing for things like Europe, the same thing for emerging markets. Their hurdles to hit earnings estimates are much, much lower at this point, therefore creating less disappointment opportunity for those markets. I haven't had to talk about recession risk for a while here. Markets got pretty quiet on recession for the first half of the year, but something just to remind you, the US is not in a recession today. And if you're feeling pretty gloom about the economy overall, this may help tell you a little bit more of the story about what is going on. So measuring real GDP, what we're looking at here is just quarter over quarter, year over year. And what you can see is the GDP, the US economy was growing at a pretty good clip through the end of 2023 and then cooled. And what we're starting to see, and just kind of trend wise, is that GDP growth is slowing. It's not going negative, indicating that we're in a really bad period. And you can kind of see the last time it really went negative, and this was calendar year 2020, when the economies, both domestically and abroad, were locked up due to the pandemic. But we have gotten back more so closer to that 2% trend. Economy is still growing. It is not in horrible shape, despite what you may read, but things are still moving along. The area to focus on, though, because this is just telling you where we are, it's not where we're going yet. The area to focus on is that 68% of our GDP is the consumer. So really what we have to focus on is how healthy is the consumer? And for the most part, the consumer's been pretty darn resilient. But we're going to show you some areas where there's some disparities with the consumer being resilient, where some cracks are appearing. I'll get to that in just one slide further, but I wanted to focus on federal finances because, occasionally it will come up, our debt's too high in this country. It's a problem. It's going to create some big event. It's been a problem for a long time. And really coming out of the tech bubble, call it late 2000s, our debt to GDP down here at the bottom, our debt level relative to the GDP we produce as a country has been growing. And if you think it's going to change anytime soon, over the next 10 years, two things to look at. If the current tax regime, which was created with the Tax Cut and Jobs Act in 2017, if you expect lower tax rates and that to just get redone again or renewed, what that does is it tells us over the next 10 years, our debt to GDP is going to go from 100% to 133% because our tax revenues are lower and the deficit spending is going to continue. If we have those revert back to where they were before 2017, it's still a problem. We're at 122%, but any extension of easier tax policy at this point with the spending level, we have to remember is going to grow that, and it can continue to be a problem that just weighs and wears on markets. What that does traditionally is when the debt to GDP gets too high, it really squanders the growth, the GDP growth that I was showing you on the previous slide. It's not a cause for alarm today. This has been on people's minds for a decade, but it is a slow moving problem that I would say our policymakers really need to address. And there's two really key areas that no one wants to touch right now that are causing most of this, or a big chunk of it. It's Social Security and Medicare, the two areas that are requiring a lot of money to go into them to keep them funded. So those are the things that are really the biggest contributors to this. Yes, I know there's wasteful spending. We all can complain about it and have, 2-hour long conversations and feel better at the end of them. But really, it's the Social Security side of the equation and the Medicare side that are really causing some of these deficit spendings to occur. Let's talk about inflation here. So with regards to inflation, it is moderating. And I know a lot of conversations I have with clients, I'm, a consumer as well. We all want prices to go back to the level they were in 2019. That's not what inflation really measures. Inflation is measuring the growth off the current base. In order for us to go back to 2019, we have to have something called deflation, which is negative inflation. I mean, it's eroding back to the old prices. We're just seeing right now from the peak of July 2022, a rapid decline down to more of a 3%, 3.3% level year over year growth and change in inflation. And it's kind of gotten stuck there. You can kind of see here, it started to plateau, and the Fed's always talking about this 2% target. And really there's some things that are in this inflation basket that are being stubborn. And to get to that 2%, it's going to take a lot. It's going to take longer than anybody anticipates. But what the two major components that are driving most of the current inflation around 3.3% have been the shelter side, dark blue. So think of the housing side, and red, believe it or not, auto insurance. So most of you probably have auto insurance and have seen some pretty radical increases in that. The good thing is that generally with those types of increases, they don't last forever. They tend to have a lot more competition come into the market because premiums are higher. That probably will erode faster. The shelter side is really about capacity, and you need more capacity to come online in order for that component to start to soften further. And it's out there. There is more building going on. There's more multifamily development going on, but it takes a while for it to come to market. So while the Fed is frustrated with it, two of these components really are outside of their control right now with the tools they have. But nonetheless, inflation's moderating, but to get down to that 2% is going to take a little bit of effort using the CPI as that measurement. What also is helping with inflation, meaning what those costs are getting passed on to you at this point in time, is the labor market. So what we saw back in March 2022, we saw a ton of job openings. And you may say, well, why does that lead to inflation? The more job openings, the more competition for labor. The more companies are willing to pay for that labor, pass those prices on to you. We've seen that come down. We've also seen another component of the labor market soften as well, which it's a good thing for inflation. It may not necessarily be good for those workers who potentially could lose their jobs, but nonetheless, it's coming down. The one thing to notice is those people who were quitting their job in search for a higher paying job, that too has also come off of its highs. So people are a lot more cautious right now to quit their job and expect that they're going to get paid more by moving companies. So these are things that help bring inflation, the rate of inflation down. So a cooling labor market does help, and it's been helping bring it down from the peak that we saw in 2022. Now on to the consumer. So if we want to look at that 70% of the economy and how well positioned they are, if we look on the left-hand side, what are the liabilities? What are the things that consumers have to worry about that erode into their discretionary spending? We look at mortgages. It's about 2/3 of the normal consumer's debt at this point. And the one difference there is that most of those mortgages were locked in at extremely low rates before rates started to go up. And it's kept existing homeowners, those people with mortgages, relatively immune to the inflation cost of housing, in the sense that they've locked in rates, they're not moving. That helps them with their discretionary spend in the sense that they're not seeing the interest rate work against them right now. As far as looking at debt payments as a percent of disposable income, one of the things you hear is, oh, consumers just levered up completely and we're going to have another credit crunch because of it. I would encourage people to look at it a little bit differently. It doesn't mean not all consumers are having an issue, which I'll get to in a moment. But if we look at the percent of disposable income that debt payments are going towards, we're not even at the level they were in 1980. We're sitting over here at about 9.7%, so slightly below, and we're definitely well below where we were prior to the financial crisis taking hold. It doesn't mean everything's all rosy, and we can kind of see that if we move to the bottom right-hand corner. This is where disparity on incomes and things of that nature are going to come into play, because immediately you're going to look at this and go, oh, look, credit card defaults are going up. Oh, look, auto loans are going up. The question is, where are they going up? It's predominantly hitting the lower income or middle income communities harder here. And that's really where that credit defaults, or where these credit defaults are occurring. It's not necessarily, say, the people that generally own more of the financial assets out there who are covering their debts and still consuming. So we do have the lower and middle income areas of the credit markets roughly getting squeezed here. And a lot of that has to do with the high inflation, and also the payrolls are not increasing at the same rate at this point going forward. So a little bit of crack here, something to watch. Doesn't mean that this is going to turn into a 2008 all over again, because a lot of what they have locked in here under mortgage rates are fixed rates that are well below where they are at currently if you had to go get a new mortgage today. So let's talk about some investment principles and some good reminders, things that I'd like you to just kind of keep in the back of your mind as we go through the remainder of this year, and even pull these out in 10 years, and it's probably going to tell you the same story. One of the things that we heard a lot about before the last 2 weeks was, oh, the market's hitting an all-time high. The market's hitting an all-time high. And a lot of the time what that'll trigger is an emotional reaction from people that will say, hey, well, if the market's high, you know, we shouldn't invest. And what we can kind of break down here is going back to 1957, a variety of decades where the markets hit all-time highs. And so like in the 1990s, there were 310 market highs. In the 2010s, there were 242. So far in the 2020s, we've had 135. So on average, you usually get 25 all-time highs within a calendar year. We're at about 31 so far this year. So nothing wildly out of whack with what traditionally happens when markets hit all-time highs. Markets generally continue to grow over time. That's what's allowed for all these all-time highs. Something to keep in mind, though, is that if a market hits an all-time high, it doesn't necessarily mean it's going to cause a negative return going forward. And the thing to think about is, if we look at these pie charts on the far right-hand side, what this is going to measure is what's the 1-year return following the all-time high. And so close to 70% of the time, the 1-year return following the all-time high has been positive. 31% of the time it's been negative. If you go out and you stretch that over a longer time period because you have more time to work with, 86% of the time things are positive if you invested at an all-time high following that. 5 years out, 82%. So don't let necessarily the all-time highs spook you. Those are not necessarily market indicators that the market has to fall after they've hit that. The other good education piece or reminder here, and this is just looking at stocks, US stocks, because they're very easy to measure and keep things simple for you to observe. With regards to timing the market, I'm going to cover what it's like if you miss some of the best days in the market, which also means you're going to participate in some of the worst days as well. But if you miss some of the best days in the market, it really can have a catastrophic return for you. So let's look at the far left-hand column. If you invested $100,000 10 years ago and just put it into the S&P 500, it'd be worth about $311,000. Now, what's beautiful about looking at that is you forgot all the volatility and all the worries and every crisis du jour we've had since then, but that's been the result of it. If you just sat out of the market for 10 of the best days, so 10 days in 10 years, you had 170,000. So it was roughly half the return you would have gotten if you just stuck your head in the sand. If you missed the 20 best days, even lower. So 20 days out of 10 years, it's not a lot of time. If you miss the 30 best days, so just think 1 month in terms over 10 years. If you missed the 30 best days, trading days within the market, your return actually ended up being negative. So it's just a reminder, if you're going to try to get in and out of stocks, it's very difficult. And I would love to be able to tell you when to miss the worst days and only buy on the best days, but that's been virtually something that has been impossible to do for most. And it's better to really look at your stock side of your portfolio if you can stomach the risk as a buy and hold type strategy. This chart's going to be a little bit more for investment principles, and it's not going to be in these for very long because this really is using the Olympics since we're in the middle of those right now. It's using the Olympics and going back to 1984 when the Olympics were in Los Angeles. And it's just showing a different picture than what you've seen before. But looking at the gold, silver, and bronze medalists, what this is going to look at is 1 year, who's positive and who gets the highest positive ratings 5 years out, and then 20 years rolling. And really, at the end of the day, in the sprints in the short run, if we go back 40 years here, cash has always been 100%. Cash doesn't go negative. It doesn't have that negative shock that, say, bonds will have. But if we look at it, over the last 40 years, cash has been 100% positive all of the time. Bonds have been about 87% in 1 year periods positive. If we blend stocks half and half with bonds, about 86% of the time. So in the short run, cash wins, right? It just wins because it never goes negative as far as what's being measured here. If you go further out, your odds of losing money, you're still positive 100% of the time on cash. Stocks and bonds over the last 40 years, 99.5% of the time have been positive over a 5 year period. Bonds, 98.6. The long runs, even longer, believe it or not, stocks and bonds on a blended portfolio produced a better rate of return than just owning bonds or just owning cash. And we can kind of look at it even further, break it down even further here. The 1 year average return over the last 40 years for a stock bond portfolio has been about 9.4%, where it's been about 3.4 on cash. The 5 year average return, 8.8 on stocks and bonds, 6 on bonds, 3.2 on cash. And then if you just look at $1 invested in 1984, a stock bond portfolio would be worth about $33, almost $34. A bond portfolio, almost 11. A cash portfolio, just shy of 4. So just a reminder, the more time you have in those riskier markets like stocks, the more time you have for things like bonds. Yes, they will have periods of negative returns and they will lose to cash over very short sprints. But nonetheless, over a long enough period of time, they generally produce better rates of return. Let's move over to politics because not my favorite subject, but this is going to be more of a discussion point. Just as we enter or go into the election cycle towards the end of the year, if you can just remember this, I'll say it once, leave your politics out of your investing. And I'll tell you why in just a moment here. What this is looking at is confidence by consumer confidence by political leaning. So red would be Republican, blue would be Democrat. And it looks at the various areas here of Bush, Obama, Trump, and then Biden. And what you'll notice is that when the certain party is in power, that party has a higher consumer confidence about the economy. And the opposing party has a lower consumer confidence. You can see it flip here. So it went from Republicans feeling better about the economy during Bush. During Obama, Republicans felt worse about the economy. Democrats felt better. It flipped with Trump. It flipped with Biden. And yet, when we look at it over these periods of time, you generally had markets doing completely opposite things. So no matter how much you hated the economy during the Obama era, let's say, it was one of the better returning eras because we were coming out of a shock, essentially. The global financial crisis created some value opportunities that led to very high rates of return following it. So I always say, leave your politics out of it. You can have them, but really do not let them influence your portfolio. to say that even a little bit different, because we get the question, well, I'll wait till the election because, we want to see what's going to happen. This is looking at the last 12 election cycles that we've had in the US and looking at what a balanced 60% stock, 40% bond portfolio would have done. 11 out of the last 12 election years have been positive for that portfolio. The one exception was the financial crisis. And I will remind you that financial crisis was not just because we had an election in November. That was a lot of things leading up to it and from the prior years, and it was global in nature. It led to a lot of financial sellouts. But nonetheless, if you look at the average over time, most of the time election years produce positive rates of return. So just waiting to the end of the election. Markets usually get a little volatile before the election, but once it happens, there tends to be a rally out of it because there is now some certainty on what they're working with. And I'll finish up here in just 2 seconds. This is more just we've talked a lot about stocks. We talked a lot about public bonds. We talked about easily observable markets. To help diversify even further beyond just using public stocks and bonds, one of the things that we spend a lot of time on is trying to integrate alternatives into portfolios. So thinking of private markets, things that do not publicly trade every single day, there is a broad, vast opportunity set out there beyond just having to depend on stocks and bonds working, and being able to add in things to portfolios that can diversify and behave at different points in time when bonds and stocks may not be behaving. I'll use some examples. So private real estate, a lot of the time you invest in private real estate mainly for the income component to it. And historically, it's had a pretty low, if not negatively correlated return, meaning it's not all that responsive to what public stocks and public bonds are doing to generate that return. So it's a good bond substitute in the sense of it's a diversifier to just only holding bonds for income. You move out the risk spectrum a little bit, private lending, so direct lending, private markets for debt, credit, things of that nature. Generally high single digit, low double digit rates of income out of that, but still lower correlation than what stocks and bonds, lower correlation to what traditional stocks and bonds would have. So a good place to have a piece of that in a portfolio. And then one thing that we've been layering into portfolios over the last couple of years, just if clients can meet the liquidity and the minimums and the investor requirements, is private market, private equity investing, meaning instead of having to just invest in public stocks, you're investing in private stocks there. And yes, private equity has a higher correlation to traditional markets, but at the same time, it's been compensating investors with above level rates of return relative to the public markets. So there are ways to look to the private markets to have some additional diversification. I would not say that you would ever do 100% of this on a portfolio, but they are good complements overall to a traditional portfolio of stocks and bonds. So I covered pretty much everything here. I'm sure you'll read the disclosures, but I'm happy to open this up for some Q&A at this point in time if we can. So if you want to type in a question in the question and answer field, I should be able to see those. So we had a question come in. So based on the analysis, are you planning on making any adjustments or changes to the investment selections? And the answer is we're continuing to look as markets particularly change. One of the big factors is that products are always changing as well. So as markets develop new products, things of that nature, I'll use one example within private real estate. Products have changed since we started investing in it well over 10 years ago. And there has been a change that's going to start occurring because of that. So yes, we are looking at both product development, meaning ways to access those markets, but also looking for ways to shift portfolios and rebalance as well. Is it possible for attendees to get a copy of the slide deck? Yes, with a caveat, assuming I can have it distributed from a compliance standpoint, but I would have no problem sharing this with you. Is HH still using the 60/40 model? No, we haven't for a long time. In fact, that was the whole genesis of talking about private markets and being able to still have the 60/40 framework, and particularly alternatives came more into play in the portfolio a little bit more heavily as we were sitting in a bond environment, that 40% side of the portfolio, sitting in a bond environment where interest rates were held at close to zero for such a long time. Being able to move into alternatives to really get less money dependent on bonds in the portfolio. I still think it's a good idea to own stocks for the long run, as I showed you the return capability out of them. You just got to be able to deal with the volatility of those and the fits that markets can go through, like they have, say, the previous 2 days, not today, but the previous 2 days. And the other factor is, yes, the 60/40 is a starting point, meaning it's a good, call it middle of the road portfolio or framework. But for people who are accumulating, meaning they're growing their balance sheets, trying to invest, they're younger, they have a long working career, they may not be in a 60/40 portfolio. They may be more like 80/20 or 90/10 because they really want to see the stock market. They can stomach the stock market volatility. They're not, say, like a retiree who's drawing on their portfolio that really should not be taking 40% drawdowns and still pulling their own money out of the portfolio during those environments. A good question. Well, I hope it looks like all the questions that have come through. Thank you for those of you who posed those. If you have any follow-up, please let your team know here at HH. And then lastly, you will likely get prompted for a survey when you close out. If you don't mind taking a few minutes, it'll just help us get better with these. And we appreciate your time today. So thank you, and I will sign off.